It wasn't a sudden speculative frenzy driven by retail traders on a message board. It wasn't a geopolitical maneuver orchestrated by a rival superpower to destabilize the dollar. It wasn't even a technical error in the high-frequency trading algorithms that govern the futures markets. It was the inevitable mathematical result of a 40-year debt cycle hitting its terminal phase. The number is $47 billion. That is not an estimate, that is the capital requirement. The deadline is January 15th. The mechanism is a forced reallocation of institutional assets. Most observers see a price chart. The smart money sees a liquidity crisis. When the largest pools of capital in the world are forced to move, they do not move quietly. They move like a tsunami. First, the water recedes. Then the wave arrives. We are currently in the phase where the water is receding. The shoreline is bare. The cracks in the paper market are visible to the naked eye, and the pension funds, the entities responsible for the retirement security of millions, are about to step into a market that is too small to accommodate them. Think about what that means. The silver market is microscopic compared to the bond market. If a fraction of 1% of global pension assets reallocates to silver, the price cannot simply adjust. The market breaks, the physical supply vanishes. The paper premiums explode. We have seen this pattern before. We have seen what happens when the exit door is too small for the crowd. Trying to leave, the incentives are aligned for a shock. The constraints are tightening, and the arithmetic is merciless. This isn't prophecy, it's positioning under constraints. To understand why this wave is hitting now, we must look at the historical record of how elite capital positions itself before a systemic rupture. We must examine the moments when the rules of the game changed, and how the largest players moved before the public knew the game was over. History provides us with 3 distinct case files of positioning under stress. Each one reveals the same mechanism. Liquidity dries up, counterparty risk spikes, and the smart money flees to assets that have no counterparty liability. Case file 1 takes us to the autumn of 1929. New York City, the roaring 20s were ending not with a whimper, but with a credit-fueled explosion of leverage. The popular narrative is that everyone was surprised. The reality is that the insiders were already positioning for the collapse. Months in advance, the constraint was the call money rate. Brokerage loans had expanded to over $8 billion. The interest rate to borrow money to buy stocks had risen to 20%. Under these constraints, the rational move for those who understood the plumbing was to exit. Bernard Baruch, the financier and statesman, began selling his positions in early 1929. He didn't sell because he had a crystal ball. He sold because the cost of leverage had exceeded the potential for yield. The arithmetic no longer worked. Joseph Kennedy, the patriarch of the Kennedy dynasty, famously exited the market after a shoeshine boy gave him stock tips. While the anecdote is charming, the financial reality was colder. Kennedy saw that the market lacked depth. He saw that the volume was being driven by margin, not by earnings. When the crash came in October, the liquidity evaporated instantly. On Black Tuesday, the ticker tape lagged hours behind the actual trading. Prices on the floor were collapsing, but the public watching the tape in brokerage offices across the country saw prices that were already hours old. They were buying into a market that had already ceased to exist. The positioning of the elite was simple. They moved from paper claims on future earnings to cash and gold. They moved from risk to safety. They understood that in a liquidity crisis, the return asterisk on asterisk your money matters less than the return asterisk of asterisk your money. The pension funds today are facing a similar calculus. They are holding paper promises that are losing value in real terms. They are looking at a stock market driven by a handful of companies and a bond market that guarantees a loss in purchasing power. Just like the insiders of 1929, they are looking for the exit, but this time the exit is not cash. Cash is the liability of the state. The exit is hard assets. Case file 2 moves us to the inflationary crisis of the 1970s, specifically the silver panic of 1979 and 1980. The context was a decade of monetary debasement. President Nixon had closed the gold window in 1971. Inflation was running in the double digits. The constraint facing wealth holders was the rapid erosion of purchasing power. Holding bonds was financial suicide. The yield on a 10-year Treasury bond was far below the rate of inflation. The incentive was to borrow depreciating dollars and buy appreciating assets. Enter the Hunt brothers. Nelson Bunker Hunt and William Herbert Hunt, Texas oil tycoons, who understood that the dollar was broken. They didn't buy silver to corner the market for sport. They bought silver because they believed the US dollar would eventually become worthless. They were positioning themselves against the collapse of fiat currency. They began buying physical silver and silver futures contracts in massive quantities. By January 1980, the price of silver had surged from $6 to nearly $50 an ounce. The panic was not just in the futures pits of Chicago and New York. It was in the living rooms of America. People lined up around the block at coin shops to sell their silverware, their tea sets, and their jewelry. The refineries could not keep up with the melt volume, but here is the key. The establishment could not allow the price of a monetary metal to signal the death of the dollar. The rules were changed overnight. The exchanges, under pressure from the Federal Reserve and the major banks, altered the margin requirements. They declared liquidation. Only trading traders were only allowed to sell, not to buy. The Hunt brothers, who were leveraged to the hilt, were forced to liquidate. The price collapsed, but the lesson remains. The smart money identified the constraint inflation. They identified the asset silver, and they moved with such force that it broke the market mechanism. Today, the inflation dynamic is returning, but the players are different. It is not two brothers from Texas. It is sovereign wealth, funds and pension systems with trillions of dollars in assets. The Hunt brothers had billions. The entities moving now have tens of trillions. If they attempt to position themselves in silver, the price action of 1980 will look like a flatline case file. 3 brings us to the great financial crisis of 2008. The constraint here was not inflation but counterparty risk. The banking system had built a mountain of derivatives on top of shaky subprime mortgage collateral. The banks stopped trusting each other. The interbank lending market froze. The positioning of the few who saw it coming was legendary. John Paulson, Michael Burry, they bought credit default swaps insurance against the collapse of the bonds. But look at the behavior of the larger institutions. Look at the money market funds. When the Reserve Primary Fund broke the buck after the Lehman Brothers collapse, a panic wave hit the system. Hundreds of billions of dollars fled the commercial paper market. Where did it go? It went into short-term U.S. Treasuries. At that time, Treasuries were considered the only risk-free asset. The yield on the 3-month Treasury bill went to 0. Investors were willing to lend to the government for free just to know their money would be there in the morning. The positioning was driven by a desperate need for collateral that no one else had a claim on. In 2008, the safe haven was government debt. This is the critical difference today. In the coming crisis, government debt is the source of the risk. The U.S. government is adding $1 trillion of debt every 100 days. The interest payments on the debt now exceed the defense budget. Institutional managers know this. They know that in the next liquidity freeze, running to treasuries is running into the burning building. They need a new safe haven. They need an asset that has no counterparty risk, no liability attached to it, and a history of surviving sovereign defaults. They need gold and silver. Just like in 1929, the leverage is extreme. Just like in the 1970s, the currency is being debased. Just like in 2008, the counterparty risk is systemic. But this time, all 3 constraints are active simultaneously. This brings us to the mechanics of the current situation. The constraint engine driving this $47 billion wave is the concept of funded status and asset liability matching. Pension funds operate on a simple equation. They have future liabilities, the checks they must write to retirees in 10, 20, or 30 years. They have current assets, the stocks and bonds they hold today. To make sure the assets grow enough to cover the liabilities, they need a specific rate of return. For decades, the standard model was the 60-40 portfolio. 60% stocks, 40% bonds. Bonds provided the safety and the yield, stocks provided the growth. That model is dead. With interest rates volatile and inflation, sticky bonds have become a source of volatility, not safety. In 2022, the safe part of the portfolio lost nearly as much as the risky part. Pension fund managers are now staring at a terrifying reality. If inflation remains at 3 or 4% and bonds yield 4 or 5%, their real return is near 0. They cannot meet their future obligations. They are mathematically insolvent. Under these constraints, the rational move is to diversify into alternative assets, commodities, real estate, private equity, and precious metals. The allocation to commodities in most pension funds is currently less than 2%. Some estimates put it near 0.5%. The January 15th dynamic represents the start of a new fiscal allocation cycle. Investment committees meet quarterly and annually to rebalance. The data suggests a massive shift is being approved in boardrooms globally. They are moving to increase their allocation to commodities to 5% or more. Let's do the arithmetic. Global pension assets are estimated at over $50 trillion, a shift of just 0.1%, 1/10 of 1% is $50 billion. That is roughly the figure we are seeing, $47 billion targeting the sector. Now consider the size of the silver market. The annual production of silver is roughly 850 million ounces at $30 an ounce. The entire annual mine supply is worth about $25 billion. Think about that. The shift of a fraction of a percent of pension assets is double the value of every ounce of silver mined in a single year, and that is before we account for industrial demand. Solar panels alone are consuming nearly 20% of the annual supply. Electronics, electric vehicles, and medical devices consume another large tranche. The amount of silver available for investment is tiny. It is a puddle, and a whale is about to jump into it. The cracks in the paper market are already appearing. The COMEX, the primary exchange for silver futures in New York, operates on a fractional reserve basis. For every ounce of physical silver in the registered vaults, there are hundreds of ounces of paper claims. Traded, this system works as long as no one asks for the metal. It works as long as investors are happy to settle in cash. But pension funds are not day traders. When they allocate to an asset class for long-term hold, they often require allocated storage. They want the title to the metal. They want to remove the counterparty risk of the exchange. If $47 billion of demand hits a market where the available investment grade silver is worth a fraction of that, the price must disconnect. The paper price set by high-frequency algorithms and bank trading desks will become irrelevant. The physical price, the cost to actually acquire 1,000-ounce bars, will skyrocket. We are seeing the precursors now. Premiums on physical coins are elevated. Delays in delivery for large orders are becoming common. The vaults in London and New York are seeing inventories drain at a steady pace. This is the water receding phase. The inventory is leaving the public exchanges and moving into private vaults. It is moving into the hands of the entities that do not sell. When the pension funds execute their mandates, they will find that the offer side of the book is empty. There is a counterargument to this thesis. Skeptics will point out that silver has been a widowmaker trade for decades. They will argue that industrial demand will plummet in a recession, freeing up supply. They will say that the Federal Reserve will crush inflation, making hard assets less attractive. They will point to the strength of the dollar relative to other currencies. These arguments rely on the assumption that the old rules still apply. They assume that a recession today looks like a recession in 1990. But the incentives have changed. In a recession today, the government response will be to print money they cannot allow. Deflation, because the debt load is too high. Deflation increases the real value of debt, which would bankrupt the sovereign. Therefore, a recession is inflationary for the money supply. It triggers the printing press. Pension managers know this. They are not buying silver as a bet on industrial growth. They are buying it as insurance against monetary debasement. Furthermore, the industrial demand for silver is inelastic. It is essential for the green energy transition. You cannot build a solar panel without silver. You cannot build an advanced missile guidance system without silver. Governments have mandated the transition to green energy. They have mandated the defense buildup. These are political imperatives that override market signals, so the demand is locked in by government decree. The supply is constrained by geology and decades of underinvestment in mining, and the monetary demand is being ignited by the solvency crisis of the pension system. The skeptic's argument fails because it ignores the structural nature of the shortage. Current data suggest we are entering a period of extreme volatility. Most observers agree that the silver market is one of the most manipulated and tightly coiled markets in existence. When the coil springs, the energy release will be violent. We can map the potential outcomes into three distinct endgames. The first endgame is controlled decline. In this scenario, the central banks manage the transition. They allow the price of silver and gold to rise slowly to account for the inflation of the currency. They use financial repression, keeping interest rates below the rate of inflation to erode the real value of the debt. Silver acts as a steady store of value, outperforming bonds and cash, but not exploding in a parabolic spike. This is the path the authorities prefer. It maintains the illusion of stability. It keeps the pension funds solvent in nominal terms. The second endgame is chaotic collapse. If a major bullion bank declares force majeure stating they cannot deliver the metal they owe, panic ensues. The price of physical silver decouples completely from the paper price. We could see a scenario where the spot price on the screen says $35, but you cannot buy an ounce for less than $100. The exchange is shut down. Supply chains freeze. This is the 1980 scenario on steroids. In this environment, silver is not just an investment. It is a survival asset. Wealth is transferred violently from those holding paper to those holding metal. The anchor date for this kind of chaos is the London gold pool collapse of 1968, but accelerated by modern algorithmic trading. This is the long-term resolution. A new unit of account is introduced, possibly a central bank digital currency, CBDC, but it must be pegged to something tangible to restore trust. Holders of the metal are the new captains of capital. Those who waited for the official announcement are left with the old currency. The precedent here is the revaluation of gold by Franklin Roosevelt in 1934, when the price was raised from $20.67 to $35. Overnight, the holders of gold made a massive profit in nominal terms. The holders of dollars were devalued. The pattern is unmistakable. The constraints on the pension funds are real. The supply shortage is real. The $47 billion figure is a mathematical derivation of necessary allocation. Shifts. The wave is starting now. By the time the headlines confirm it, the positioning phase will be over. The window to act is closing. The only variable is timing and pain. Subscribe to this channel to stay ahead of the data. Educate yourself on the mechanics of the physical market versus the paper market. Build resilience into your personal supply chain. Do not rely on the systems that are currently under stress to save you. Watch the inventory levels, watch the premiums. The signal is flashing red.